Hey everyone, Dalton Grados here with Grados Capital for our weekly market newsletter. By the way, apologies, I was out last week. I was sick and also working from home and very busy catching up on a lot at my real job while also battling a fever. So I was just in it. But we're back at it this week, and if you are not getting these newsletters sent to your email inbox, make sure to subscribe to that. The first link in the description of the video. Totally free, but just make sure that you get these sent to your inbox because I would say probably majority of the time I will do it in written form. And then sometimes I'll do a video like this. So just make sure you subscribe to that. Of course, subscribe to the YouTube channel, and then first link in the description. You will get those emails sent to your inbox, no cost to that. So let's go ahead and first look at the charts. We're going to get into fundamentals, okay? We got a lot coming up this week. And by the way, this week is going to be a shortened week. So tomorrow, the 20th, is Martin Luther King Day. Markets are closed. Futures markets are open until 1 p.m. So you will still be able to trade futures until 1 p.m., but you have Martin Luther King Day, you have Trump inauguration, probably not the best day to be active in the markets anyway. So we're going to be anyway looking ahead at this week of the 20th to the 24th. So if we look at the ES and the NQ here, what do you see on the daily chart? I am seeing both ES and NQ, probably a little more pronounced on the NQ, is a big bull flag. If I can get my drawing tool, all right, a big bull flag, all right. So you got this uptrend here, you're flagging for a potential continuation. Same thing a little bit on ES. If we maximize this, we got an uptrend and we are flagging. So for our key levels, I would say, this channel can definitely keep holding. So this range between, call it the 6,000s to the 5,800s could still be a range, but breaking nicely above this, out and above like 6,050 area, this zone, and breaking out could really make a nice leg up to the upside. Now, we remember when Trump was elected, we saw a big run in the markets. Now he's going to be inaugurated and begin his first days actually in office as president again. So could that potentially be the catalyst for markets to make another run up again? That's what I would be looking for. And then invalidation to the downside, I would say would definitely be below these 5,800s. Could cause a nice breakdown there, even if we zoom out more to the weekly chart. Oh yeah, the bull flag is really more pronounced even on the weekly chart, which is, of course, higher time frames are going to be more reliable and statistically significant. So the higher the time frame, the more significant. We definitely see that even more on the weekly. But below this 5,800 level, you can see this here if you're looking at over to the right, 5,800 level in the ES really would invalidate that to the downside. So as long as we hold above 5,800, I could see us potentially making another run up to new all-time highs in the S&P. And the story is pretty much the same with the NASDAQ if we look at the NASDAQ here. Okay, so again, I'll get you your levels for that. We are looking at, around the 21,000s. 21,000s are really our key support areas here, and then really a nice breakout above 21,700 to 800s, 21,800 call it, would really set up a nice leg up. Now let's go ahead and look at those bond yields that we talked about a few weeks ago, the 10-year yield and the 10-year yield which is inversely correlated with the actual price of the 10-year note. We talked about the relation to that a few weeks ago. So 10-year yields are coming down a little bit. 10-year notes are catching a bid a little bit. I mean, we're really just kind of catching a bid at support here. So 10-year notes have been kind of really trading in a range, but we talked about how buyers coming into the bond market means that they are moving money away from risk and into safety. So if we see these bonds go up, the yields come down, that could mean, again, money moving away from the stock market. Could be a warning signal to the downside in the stock market, but so we're getting a little bit of a bid here, but nothing really significant, just kind of buying up at support back into range. So that's kind of the technical outlook as far as I'm concerned. Again, we got that Trump inauguration, so will we see a positive market catalyst from that? Then we'll have to see. Other than the inauguration, let's see what fundamental events we have coming up for this week. So we have our CPI on Tuesday at 8:30 a.m. And I'm sorry, I should have looked at this beforehand. That is for Canada, so don't need to worry about that in America. I was looking at the red folders are typically important, but let's look at the currency here. Unemployment claims on Thursday for the U.S. And Friday looks like we got a bunch of stuff. Manufacturing PMI, services PMI. So here's how I'm looking at this economic data. And, I work professionally in the industry too, so I'm on some of these industry calls. And the consensus is that the market is in a good news is bad news reaction environment. So what that means is, and we've talked about this before, is that the market right now is really seeing the biggest risk is that the Fed will reverse course and hike rates again. That is the biggest concern for the market right now. So in these newsletters, I've talked about, things that the market cares about and things that the market does not care about. And, things largely related to politics, a lot of those things the market tends to shrug off. I remember I was trading actively on January 6th, 2021 when they stormed the Capitol. The market doesn't react to that stuff at all. Amateurs would maybe think that it does, but it's really concerned about the Fed and what the Fed is going to do as far as easing rates. So we got a Fed easing of rates. Since then, we have gotten the signal from the Fed that there will be less rate cuts in 2025 than we previously thought, meaning we'll hold rates higher for longer. We're not going to cut as fast. And by the way, why would we, right? So the whole talk of 2024 was soft landing, soft landing, soft landing. Well, the economy, through these numbers that we look at, these retail sales and this the manufacturing PMI and things like non-farm payrolls and things like that, these metrics that we use to measure the economy has grown. The resilient American economy is still strong. The consumer is still active. You have consumer spending is still high. Jobs are still good. Unemployment is still good. So the economy has gotten better. So now the term that they're floating around is no landing, right? There's no landing because the Fed hasn't really had to touch rates that much. And the economy has repaired itself. The economy has remained strong and inflation has remained pretty much stable, right? So if inflation is not coming down, but the economy is still running strong, there's no concerns in the labor market, there's really no reason for the Fed to lower rates. The reason they lower rates is to help the economy, because when they hike rates, that hurts people economically. That makes it harder for companies to lend or to borrow money. It makes it more expensive for them, and it has this whole chain reaction, right? When you hike the rates, you're increasing the cost of money. So if the economy is going to be strong, and then our primary concern, the Fed's primary concern, becomes inflation. Okay, well, if we cut rates when we don't need to cut rates, then that's just going to hike up inflation again. And then if inflation goes up again, then we need to turn around and hike rates again to get inflation under control. Does that make sense? So we've cut rates. We have less rate cuts ahead than were previously thought. And that's fine. The market is okay with that for now. But the biggest concern is if inflation starts rearing its ugly head again and the Fed is forced to hike rates again. The market is not going to like that. So why do I explain all that? Because if you are going to be paying, and you might not be paying attention to it if you're a day trader, but if you're a more astute investor, you probably want to pay attention to these economic numbers here. And what we are in is bad news is good news and good news is bad news environment. So what that means is if unemployment is bad, that means that the labor market is struggling. If the labor market is struggling, the Fed will have to cut rates. It gives them more of a reason to cut rates. So that's good for the market. So if unemployment is bad, people are losing their jobs, that is good for the stock market, because the Fed, it is a signal that the Fed could cut rates or definitely not hike rates. We would right? Remember, that's the main thing. We want to avoid hiking. So they will at least keep things where they are or maybe even cut. If we get, what's our other one? Manufacturing PMI, same thing. If manufacturing PMI is bad, the economy is bad, the labor market's bad, the Fed needs to help. And so that is good for the stock market. And vice versa. If it's good, right? If people are working their jobs and these numbers are good, then, oh crap, the Fed has no reason to cut. Right? So that's how we want to think about these numbers. And hopefully that all makes sense. So I think that wraps it up for me for this week. I think that's pretty much all I have as far as my technical levels and fundamentals for the market for this week. Again, like, comment, subscribe on the video, subscribe to the channel, and subscribe to the newsletter. All of that is free, and I do not sell anything. So hopefully you enjoyed this video. Leave a comment, by the way, make this interactive, and I'll see you guys next time.